Hello, Thursday. Howdy doody. Start in the United States of America. ISM reports have basically come out around the world, and the United States one is alright. It's okay. On the good side of okay. But one of the important parts in there, apparently, I've only just come across this, is the prices paid component. The prices paid index can be made out of that report, and for a goodly while apparently people buying treasuries have relied on it to gauge how much they want to pay for treasuries with regard to inflation based on that prices paid index in the ISM. Now on this chart, which I know isn't very good, but it's the white step up are the prices paid index going upwards, and just at the background you can see the red wiggly line, which is a bit top left bottom right on its way downwards. Those are the interest rates on the 10-year treasury yield. Now all things being equal, and going back to what happened in the past, has always happened, those two things do not go in opposite directions, they go in the same directions. So the prices paid index on the next ISM has got to come down, or 10-year treasury yields have got to go up. But of course we must take into account that these are not now ordinary times, so we never know. Things can go all queer-like. Net John Carney, so this is CNBC, Treasury considers going negative on T-bills. The US Treasury is considering permitting negative interest rate bids in auctions for Treasury bills. Read the article to see what it is. I was going to read the whole article, but then I found I had tabs open all the way across and stuffed up with things I want to give you. So if you're interested in that, follow the link. We could call it a contrary indicator that the Treasury is considering permitting negative interest rate bids, and things might change and those bids might never come as the interest rate as rated in the first link start going up again. Maybe. Plosser, one of our Fed people from yesterday, a top Federal Reserve official, sharply criticised the US central bank's decision last week to telegraph ultra-low interest rates for nearly 3 years more, saying on Wednesday the move undermined confidence and caused confusion. Now, I'm sure what the Fed is trying to do is to do anti-confusion by saying 3 years more interest rates will be ultra-low, so you know where you are and you can plan appropriately. But of course that doesn't quite cut it, does it? If the economy booms, do interest rates still stay down for 3 years? Or is it a guarantee that the economy won't boom and interest rates will stay down, and many other things? It doesn't actually give clarity. I agree with Plosser. I think it gives confusion. More confusion. Okay, this is a stop and throw in Grigor. Above this is the oil production of the world chart, which I haven't given you because I've given you so many times before. 2005, it was at the same amount that it is now. Opening paragraph. Since 2005, European oil consumption has fallen by 1.5 million barrels a day. And in the same period, US oil consumption has fallen by 2 million barrels a day. If oil was priced at $60 a barrel rather than $100 a barrel, then a fair portion of that lost demand might return. Are you keeping up? Instead, since 2005, global crude oil production has been bumping up against a ceiling of about 74 million barrels a day. Thus, the tremendous growth in oil demand which emanates from the developing world, in Asia primarily, has been supplied by the reduction in demand in Europe and the United States. Why doesn't the world simply increase the production of oil to 77 or 78 million barrels a day? Question mark. After all, that's precisely the history of global oil production and continual increase in supply to capture the advantage of rising prices. And obviously you read the rest of the article to find out why everything seems to be stuck at 74 million barrels a day. Slightly different angle. This is China blocks Vale's large iron ore carriers. That looks like a super tanker, but apparently it's a huge, large iron ore carrier coming up from Brazil, Vale. The world shipping industry on Tuesday was struggling to digest the implications of an unexpected Chinese government ruling that restricts ports' rights to accept many large bulk carriers and tankers. The ruling from China's Ministry of Transport could end the hopes of Vale, the Brazilian miner, of making full use of its new series of large ships. They had to go to what were super tanker type things to get their iron ore to China, who's the major buyer, to make it equally as cheap as Australia, who's got a shorter trip. But political shenanigans in the Chinese government have pushed out Brazil and obviously are still welcoming in the Australian iron ore and their small ships. Very hard always to know what's going on when it comes to China. BBC article, China exports and imports demand dips amid global fears. The demand for Chinese exports fell in January as global economic uncertainty continued to hurt consumer confidence. Basically, the United States and Europe aren't buying as much stuff from China. So China is not exporting as much stuff and probably won't need to import as much stuff to make the stuff out of that they're not going to sell to the United States and Europe. And I know it's an article on gold, and normally I don't do anything to do with gold because there's just so much blah blah surrounding it, but this is quite interesting. It's why are the Chinese buying record quantities of gold, and it's not a boring article at all. I'll give you the skinny on it, because it's a 2-page Forbes article. It's basically that there are a lot of Chinese, well, when you compare in the whole of China, there are very few mega-rich people, but there are a lot of those mega-rich people that are thinking, if this whole Chinese economy thing falls over, then I don't stay being mega-rich anymore. I want some out on this, and one of their outs is buying gold, and it's the mega rich that's buying the gold as an example of what could be considered capital flight, which is a very important possibility for the Chinese mega wealthy to capital fly their money out of the country. And obviously if they do, that would leave China in a terrible condition. And there we go on to the United Kingdom. Philip Aldrich seems to be one of their more adroit commentators. Just look at the president. The 7-year squeeze, this is the United Kingdom, will be the tightest for public spending since records began after the Second World War. The UK has never before tried to cut spending for more than 2 years running, and then they're going to try 7. Nothing like it has been attempted in the past 40 years in any of the world's 29 advanced economies, and the nearest equivalent was the 3-year tightening in Ireland between 87 and 89 to squeeze into the euro. Then, look at what lies ahead. More than 9 out of every £10 of planned public service spending cuts are still to come. They've only done 10%. They've put quite a lot of the taxes up, but the actual spending they're kind of stuck on. Well, we'll see if they're stuck on or not, and that's the big thing. At the moment, it looks like because the United Kingdom and the United States are stuck because they don't have the political will actually to cut spending, their economies are just about holding together. It's a bit of a paradox. But if the UK ever do get their act together and do this cutting, with 90% of cutting still to come over the next 7 years, We can only imagine what the results will be. This is from a long European Central Bank document, PDF, and I've just cut this out as a representative, but it's one of these 100-page documents that's worth looking at the charts all the way, looking at the pictures anyway. But this gives us an idea, and it tells us a story, which is what I'm here to do. Factors contributing to tightening credit standards, whether banks are lending or not, and why, if they're not, why are they not? First column, cost of funds balance sheet constraint. Now, this cost of funds column, you can see, is going, these are quarters, each column is going up and up and up, and it's not cost of funds so much, I don't think, it's balance sheet constraints. It's this capital ratio shit, or the fact that they might be insolvent. Competition from other banks? No, it's not that. Expectation of general economic activity it went down, but now it's going up again. The banks are not confident about general economic activity. This is in the Eurozone. And credit worthiness of consumers is the same. They had great doubts about the credit worthiness of consumers, but that came down, but it's on its way back up again now. They just don't think, with the expectations of economic activity being bad, the creditworthiness of prospective borrowers is not enough up to scratch. But there's a lot of stuff in there for businesses and all sorts. It is rather interesting if you haven't got a life. This is one of the Greek newspapers. 60,000 shops to shut down. You can just imagine given the data for a 6.2% fall in household consumption in 2011 and Eurostat forecast for another decline of 4.3% this year. When there's not money there to be spent, obviously 60,000 shops will shut down because there aren't enough people going in and out of the shops. It's so blindingly obvious. But I don't know where they think they're going to get economic activity to pay the taxes, to pay the debts. I really don't. This is Mish, and I've just pulled this out as one little mishlet out of one of his last blogs. And Mish, I remember 3 years ago, was like myself, didn't have a clue how Europe worked. And we've both completely struggled, and we're starting to work out the mechanics of how Europe works. But this is the Eltro, which we know is swapping assets to the central bank and being replaced by cash on the asset side of the banks. Contrary to popular belief, the Eltro is not going to do much, if anything, to get banks to lend, and here are the reasons. And I'd just like to point out that I watched a Steve Keen video, half-hour video, where he said exactly the same as this, and both of them know better, and I don't know why people always explain it this way. Banks are capital impaired, if not outright insolvent. So, opportunity for me to say, what does outright insolvent mean? It means that, I've got to get it right for you, can't. Assets and liabilities. The assets, no, those will be liabilities. The liabilities have got to be less than the assets. If I don't know which way it is. If the liabilities are more than the assets, you're insolvent, and there's no equity. If the assets are bigger than the liabilities, that gap that difference is the equity. That's what's owned by the owners of the bank. There are fewer credit-worthy borrowers. That is the bottom line. Banks have 3 years guaranteed profits by speculating in government bonds. But the implication there is, and this is where I point out, why do people still always use this implication? The implication is they will not be lending because they will be buying 3-year guaranteed profits by speculating in government bonds with the cash that they have on the asset side of their balance sheet. They will not be lending because they will be buying bonds. But they would not be lending that money anyway, because they do not lend that money anyway. and it could be left there as cash for reserve requirements, but reserve requirements are really nothing anymore, and it can't be used for capital requirements because capital requirements is the asset side of the balance sheet in comparison to equity, on which is technically on the liability side of the asset on the balance sheet. So it doesn't even help with capital requirements. It just seems so simple, but nobody seems to ever explain it in the simple way. Maybe because it's not simple to explain, or it's just boring. It's easier to say they will not be lending this cash on the asset side. They'll be buying bonds with it. But it doesn't actually make sense. I've gone. Bye.